Without a doubt, there are some markets out there, and you probably see them on the nightly news, like San Diego. Can you imagine 45% of your income being devoted to a monthly payment? Miami is another one. Very recent surge in prices or in monthly payments, up near 30%. But again, we're ignoring what's going on in the vast, heartland of the country. In the southeast, outside of Florida and Virginia, in the Midwest and the Southwest, large swaths of the Northwest, monthly payments today are historically very low and well below the national average. And again, this is as a percentage of income. It's not the absolute monthly payment. It's not $1,500 or $1,600. It's a percentage of your total income. And this is what's going on in Syracuse. Incredibly strong affordability. And even though it upticked right here, again, that was when mortgage rates were rising. Right in here, prices were rising, mortgage rates were rising. Mortgage rates shot down over the last 12 months. We've seen them go from 6.8% back in August to 5.5% just about 4 weeks ago. And so that means this monthly payment shot back down again. So it's not only well below the national average, but it's below the local average. Just go ahead. Thank you. One thing that's helped keep the national housing market on track to date has been the very strong economy. It's been very resilient. Obviously, the numbers are starting to show negative. Not a surprise that there's inevitably going to be an end to every business cycle. But we have this large overhang of employment. So what's critical now is holding on to the employment that we have so that people don't start to lose their ability to finance purchases. And the majority of economists, at least looking at the National Bureau of Economic Research, are currently saying that they're expecting either a modest or very shallow recession is what they're expecting. So not a lot of slashing of jobs. Not the kind of thing we went through back in 2000, 2003, because that was more of a structural change. Because we saw a lot of our manufacturing employment move abroad to take advantage of cheaper wages. Again, and that's where the low value of the dollar actually helps us there. Locally, employment really took it on the chin from 2002 through 2004. We've seen a steady improvement, a little bit of a slowdown, but the most recent trend is very strong year-over-year growth in terms of employment. So if we can hold on to that, with time comes confidence, incomes, and equity, and the ability to make that home purchase. And also, there's a lot of long-term growth projects in the pipeline that are going to help to sustain employment growth going forward. Other things doing well. Very strong wage growth. We saw wage growth fall off. It's back up again. It's dipping just a little bit. Why that's important? If we're looking at that percentage of income devoted to home payments, well, if your income keeps rising, that means the percentage that you spend on housing decreases. So you can afford your monthly payments easier. Wages are at all-time record highs, and it's because businesses have record profits, very, very strong profits. The reason we know, and when they have big profits, what they tend to do with them, particularly towards the latter part of the business cycle, is they spend on themselves. They're reinvesting in themselves so that after the slowdown, into the next business cycle, they're competitive. They want to retain the better workers, have the better infrastructure so that they're competitive. We know that they're beginning to do this for several reasons. First of all, corporate profits are much higher than they were back in 2002, 2001. That's the last time equity markets were about this level. Why don't you switch? And as a result, they have very deep pockets so they can spend, again, on themselves, infrastructure. And that's exactly the pattern we were seeing. We saw a bit of a slowdown in the first quarter, but it's going right back up again. What's helping this pattern, and particularly here in Syracuse, weak value of the dollar. It's bringing people down from Canada to buy our goods, take advantage of our services. It's allowing us to export abroad much easier because our goods are so much cheaper. Now, we've heard about net exports continually setting record lows, and that's because we keep buying so much gas from abroad. But in terms of our exports, not net exports, but exports, we're at records. Consumer spending is also very strong. We took a real big hit the other day in terms of retail sales. That may even out for the month, but we're not relying on consumer spending. We're actually expecting it to slow down going forward. The one big worry spot and what's actually putting the crimp on consumer spending right now is the very high price of oil. We're hovering around $110 a barrel. It was $30, $35 a barrel just 2.5 years ago. really, really high, and it's beginning to flow through into food prices because of the transport. Lots of gasoline used there. So it's beginning to pass through, but it's not quite being passed on to the mortgage market yet. So that's good. We can hold that off for now. In terms of our overall economic outlook, it's likely to be, we redo this every month, once a month. It'll be revised next month, of course, because of all the information that we got this week. But right now, again, we're just anticipating a rather shallow recession, not a lot of job cutting. We're looking at an unemployment rate to rise up around where we were forecasting 5.0%. It's going to be closer to 5.2, 5.3%. But again, from a historical perspective, prior to 1990 or so, if you went below 6.5%, it would cause spiraling inflation. So, sitting at 5.5% is very comfortable in terms of where we are in terms of employment. We just want to make sure that we hold on to the employment that we have so that those people have the stability to make those home purchases. So where are all those people? We saw that overhang of demand. We saw the interest rates fall very sharply. Well, that's the trick in 2008. So far, it's been a crisis of confidence. People keep hearing about what's going on at the national level, and they can't understand how it relates to here in Syracuse, New York, and Pittsburgh, all these local areas where the national doesn't represent what's going on locally. We're actually beginning to see some things turn around at the national level, but this hasn't made headlines yet. Inventories are starting to come down, and that's a very important sign of the housing market starting to come back. That doesn't mean we're expecting prices to start shooting up again or sales to start shooting up again. It means we're coming back into balance. All right? Consumers are starting to show confidence again, and most importantly, that huge run-up in supply, which was caused by investors dumping their inventory onto the market in 2005 when sales slowed and prices slowed. We're beginning to work this off. The same is true of the new construction side. We topped out record levels. We're starting to see that inventory come down. We needed to come further. At NAR, we're actively lobbying on a daily basis to push Congress and to push the administration to act to implement some policies to help whittle down that inventory. But these are good signs, again, because it tells us we've hit a ceiling in terms of how much inventory can sit there in the market. We've hit a ceiling in terms of being able to understand the relationship between supply and demand and where prices will go. Okay. So the truth about what's going on, we hear about in the media how the banks are getting murdered right now, and builders are really, really reeling in the pain of this slowdown. Well, for builders, let's go back just a second.